Welcome to Money Habits. I'm your host, Dr. Stephanie Aldrich, and I like to talk about habits and money that can help you improve your life. If you're new to the channel and like the video, please hit the subscribe button down below. Now, the title of this video is Stop Waiting to Make Money and Do What the Rich Do. I came across an article this past week from my Trends Journal, and it talked about how the rich got richer and what they're doing. And I thought, you know what? This is an awesome article to try to start expanding our minds on how to invest and stop waiting. People wait. Oh, the stock market's too high. Oh, the interest rates are too high. This and that. This article, I think, really jumps into the mindset and methods behind the strategies of ultra wealthy people. So let's get into it. Last year, the wealth of high net worth individuals grew by 5%, basically, to $8 trillion. The rich also added to their numbers. They grew by 5%. So over 22 million people are considered high net worth individuals. And they define that as people that have liquid assets of $1 million or more. You know, in today's society, $1 million really isn't that much. So, knowing that 22 million people have net worths of over $1 million, that's pretty promising for you and I, right? So, what we found was the findings are reversed in 2024 from the 2022 trend when the ultra wealthy ranks and assets both shrank. Much of the gains from this year of how they've become more wealthy came from the U.S. Equities market, so the public stock markets, which jumped 24% this past year, including 11% in the fourth quarter of 2023. The NASDAQ, which has to do with all the tech stocks, you know, think of Nvidia and how huge they have run up in the last year. It was up 43%. In 2022, the rich wanted to keep from losing money and kept more of their assets in cash and cash equivalents. Now they want to add to their wealth. So let's jump back to 2022. Think about it. The Ukraine war started, interest rates started really going up. Economies, you know, a little shaky, whatever. Stock market kind of starting to go down. I think it was down, oh, I don't know. Don't quote me on it. Maybe 9% or something, but people were starting to freak out, right? What the ultra wealthy did, they said, hey, no problem, right? This is the normal ebbs and flows of the economic cycle. Businesses ebb and flows, stock markets ebb and flows. We always have an up and a down and a, sideways trend. They follow the trend. So instead of jumping into something that, wasn't a good fit, not very profitable, they sat on the sidelines and just built a cash position. Now, think of one of the best investors ever, Warren Buffett. He and Charlie Munger were professional, what I call wait people. They waited, they were patient. They had no problem building up a cash position. I think they had this past year $134 billion just sitting around in cash. They know that they don't want to push things. They don't want to take they don't want to take too much risk, right? If you don't have to, why take it? Sit on the sideline. If you're patient, something an opportunity will happen. There's always ups and there's always downs. When things are down, they're on sale. That's the time to pounce and add to the portfolio. You and I can do the exact same thing. When stock markets start going down, what do? Oh my gosh, we panic. Oh, I can't do it. I'm going to sell everything. This is awful. My nest egg is going down. No. No, no, that's not what you're supposed to do. It's on sale. Everybody loves sales. Women, we love sales. When the public markets go on sale, that's the time you should bounce. Put extra cash into the market because it will go back. It may take some time, but our economies are always churning over. Technology is always going to improve, science is always going to improve. We are full of innovation. That means the products and services that we use or that we will use in the future, they're always going to expand, they're always going to grow. And that is a good opportunity for you and I to jump in the market at that time and buy more stuff so that we can see it rise as the profits come in. And that's what the ultra wealthy do. They know that cash really is king. You don't want to have a big cash position for a long time, but you want to have dry powder, dry cash equivalent on the side so that when it's time to jump at an opportunity, you have the resources that you can easily be the first person to the table. All right, the article goes on to say that risk aversion is subsiding. So, what's going on now in 2024? Stock markets are the highest that they've ever been. Gold and silver prices highest that they, well, I think silver was up to 50, but gold highest it's ever been. Oil kind of, in the middle, but still strong, right? um, Cash assets are shrinking because now it's time for the wealthy to make a move. There's a lot of REITs that have to get rid of commercial spaces, which are pretty much selling pennies on a dollar after the 2020 pandemic, right? A lot of companies are keeping their people at home. Well, they don't need the office space anymore. So those office space rents, you know, the offices aren't being rented out. So those spaces are now in jeopardy of being foreclosed on at the bank because the owners can't pay their bills. There's no tenants. They're the ones that are paying the bills. So you're going to see a lot of people jumping on these office buildings that are being sold for pennies on the dollars because the REITs have to get rid of them. They have to, keep their shareholders happy. The banks, they got to get rid of them, uh, so that they don't go down under. Everyone involved, there's going to be opportunities to either turn those commercial spaces into multifamily facilities or do something different with them. But there's going to be tons of opportunities that the wealthy know now's the time to strike. And they've been collecting money this whole time, but it's starting to become time to make a move. Let's see. Stocks now amount to only 21% of the wealthy's holdings. They can afford to take risks. So many are investing in commodities, oil, silver, gold, miners, copper, lithium, things for um, EVs and, batteries production, currencies, crypto, and other digital assets, hedge funds, and private equity. I myself just found a private equity group um, that I started investing in. I'll let you know how that goes. Of course, you can do whatever you want to do, but learn from this article and start thinking and broadening your horizons to maybe diversify a little bit more. And that's what the wealthy do. They diversify in different industries with different types of assets because they're tax advantaged. You're taxed differently if you own a business compared to if you're an employee, compared to if you own a dividend stock and you are collecting the dividends, compared to someone that owns real estate. So make sure that you're diversifying the way that you're keeping your money, making your money, and investing your money. Such investments, so we're talking about the stocks and all of that, we're down to 21%, But all of these other investments, the cryptos, the hedge funds, the private equity, are now 15% of portfolios compared to 13%. So they're starting to bulk those up. Real estate accounts for 20% of their holdings. It said particularly in the form of luxury, primary, and vacation homes. Okay, sure, they're buying, bigger homes that, they're sinking improvements into so that they can flip them later. But I really think the big play of real estate is mobile home parks, storage facilities, commercial properties that they may or may not, flip into something different, developments, that kind of thing. So, looking at this, it kind of gives us an idea of other areas that we could be investing our money, like the ultra wealthy. Fixed income assets, bonds, and similar securities grew from 15% in 2022 to now 20 over 20%. The assets became more attractive as inflation ebbed and chances grew that interest rates would fall, which will bump up bond values. So as bond values rise, interest rates fall, right? They're That's how they work. So as the higher interest rates start falling, you're going to see bond prices go up, and they're going to be more attractive to for the wealthy, to banks, whoever, to purchase, right? Because they're going to start getting more money from that. So this is a different, take on becoming wealthy. Where should you be investing your money? Think about all of these different things. Fixed assets, real estate. You don't have to actually own the real estate. You can get into syndication deals like I do, where, other people own those assets, but your money is part of a pool of money that owns that. So think about it. The stock market's at all-time highs. Okay, maybe it's time to look for something that's a little more depressed, something that you can get a bigger rise in your equity from. Real estate is gonna, as the interest rates go down, I think there's going to be a flood of people in real estate. So maybe start stacking cash to diversify yourself in that way. So I thought this was an interesting article, and I definitely wanted to show it to you guys and kind of start expanding your mind, because I know it expanded my mind, and I know the last few years I've really started diversifying myself so that I'm take advantage of tax implications for different asset classes, and also making sure that I'm following those economic cycles so that if one side of the market is up and another one's kind of lagging, that I'm covered no matter what. So that's it for the show today. Thanks for watching. What did you learn from this article? I really want to know. Let me know in the comments. And until next time, this is Money Habit.